It's Friday, April 10th. Time for the morning macro snapshot. Okay, let's run the board. Live market scan just before that CPI print. Host 2, give us the levels. We've got the dollar index, the DXY, trading at 98. It's a soft environment for the dollar. The 10-year Treasury yield is holding steady at 4.32%. Elevated, but it seems stable for now. Gold spot is priced at $47.61, still acting as a solid inflation hedge. And Bitcoin's maintaining that bullish momentum. We're seeing it trade in a tight range between 72 and 73K. WTI crude is coming in at $91.80. That's just a bit off its recent highs. The S&P 500 is sitting at 68.11. It's really pushing towards new all-time highs here. And wrapping it up, the VIX is at 20. So we've got some moderate volatility, but no signs of major stress in the system.
All right, that's the board. Let's get to the main event.
And here it is, the red event of the day. U.S. CPI data just hit the wires. All right, the numbers. Core CPI month over month came in at 0.2%. That's below the 0.3% forecast, a slight miss.
And looking at it year over year, that's 2.6%, also just under the 2.7% forecast.
So the single line interpretation is this: cooling, but still sticky inflation. That's the headline. And just a reminder, the market's laser-focused on core because it strips out those volatile food and energy components.
Right. It's the metric the Fed watches most closely for underlying trends.
Okay, so with those numbers out, let's look at the cross-asset impact. How is this shaping the landscape? So we've got a split picture here. On the bullish side, equities are strong, crypto is bullish, and we have that soft US dollar. But on the other hand, the cautionary signals are there. Bond yields are still elevated over 4.3%, oil is over $90, and core inflation is persistent. This brings us to the macro transmission chain. Let's connect the dots from that inflation print to risk assets. The flow is pretty straightforward today. That cooler CPI print is helping to stabilize Treasury yields.
And those stable yields are what's causing the US dollar to soften.
Exactly. And that weaker dollar provides direct support for risk assets like equities and crypto. It's the classic chain. Lower inflation is fueling this risk-on move. Okay, let's game this out. What are the potential paths for the market over the next 24 to 72 hours? We've got 3 scenarios. Scenario 1 is a full risk-on continuation. The triggers here would be oil staying below $93 and yields remaining under 4.35%. If that happens, we'd expect the S&P to test 6,900 and Bitcoin to push towards 75K. Now, our base case is consolidation. For this to play out, we'd see oil trading between $90 and $95 and yields hovering between 4.25 and 4.40%. The market reaction would be the S&P holding the 6,750 to 6,900 range, with Bitcoin chopping between 71 and 74K. And the third scenario is a risk-off shock. The triggers here would be a future inflation print surprising to the upside, causing yields to spike above 4.45%. If that happens, you're looking at an S&P pullback to 6,650 and the VIX jumping above 25. All right, let's synthesize this. What's the final takeaway? Right now, the market is sitting somewhere between that risk-on continuation and our base case consolidation scenario. The momentum is still clearly bullish, so the overall bias remains moderately risk-on. The key variables to watch from here are simple: oil prices, bond yields, and of course, the next round of inflation data. So the bottom line is this: liquidity is definitely supporting markets right now, but those underlying inflation pressures, they haven't gone away. And that's our briefing.